what is a better time to invest when the current yield is negative because now the interest rates have gone up, or when the current yield is very positive?
I think it's the biggest mistake investors make in fixed income.
Hmm.
You can't be backward looking, especially in fixed income, right? If you see double-digit returns, that means yields have gone down to a decent degree,
Correct.
right? From whatever the starting point was.
Correct.
To expect that yields will go down by the same degree,
Hmm.
and it's not necessarily true most times. So one of the biggest mistakes I think investors make is they
Credit risk or interest rate risk, your bigger nightmare.
credit risk.
Correct.
Interest rate risk can also give you anxiety, but you can always cut that risk if you want to. Credit risk, there's very little.
YTM, the truth or illusion.
See, YTM is a promise. Depends on who's making the promise to you. If it's a AAA PSU entity or a government of India making that promise to you, it's pretty much the truth for the most part. And then as you go lower down the credit chain, that
Hello and welcome to Ventura Spotlight, where we bring you conversations with experts shaping the way India invests. In this episode, we are pleased to have with us Gautam Kaul, Senior Fund Manager, Fixed Income at Bandhan Mutual Fund. Gautam holds an MBA and a Bachelor of Commerce from University of Pune and brings over 2 decades of experience in fixed income markets with expertise in managing strategies across the yield curve. At Bandhan, he manages multiple debt funds with a total AUM of above 50,000 crores. So let's get started. Hello, Gautam, and welcome to Ventura Spotlight. And thank you for taking time out today for this show.
thank you for inviting me, sir.
Yeah. So, before we dig into what you actually get into doing on a day-to-day basis, how did you get into the debt side of the markets?
So I passed out of MBA in 2001, which was not a great time for equity markets. So in B school, all of us want to do equity, research, trading, whatever, right? So fixed income is a theoretical idea. You read about it because you have to give an exam. But I got placed into a fixed income sell-side firm called Mata Securities. Once I got into the market, I was hooked. And since then, it's been fixed income throughout.
Okay. So yeah, I mean, as you said, the equities got the excitement.
Yes.
And debt doesn't have that much of excitement. But actually, when you start looking at it, the debt side requires much more focus, and I think that debt side actually also will determine how the equity side will move. So, any thoughts on that?
They are related, right? So you're right. Debt is more niche. Right? Equity, everyone knows. Everyone can buy a share, look at the change of the price of a share every day, so that excitement is more palatable. The swings are more. Fixed income, a little more niche, but much higher ticket sizes. Connection between the two. Basically, you are part of the same capital structure, right? Debt comes before equity, and in that sense, they are always linked. Your interest rates are essentially basic cost of risk-free, and that will determine your cost of capital. If your rates go down, then you can expand valuations because your DCF model mechanically, you can expand valuations, so that helps. But even other than that, debt essentially is looking at the macro picture. So think of it as looking at the same picture, but from a much higher perspective, from let's say a 30,000 view of something, whereas equity is more on the ground. Your 30,000 feet view is also a reflection of amalgamation of whatever is happening in the ground. So if you want to understand what is happening on the ground, you also have to take the 30,000 view and understand how things are moving and how things are likely to move. So I think they are both linked.
So, since started from 2001, I mean, I think you are now nearly 25 years into the debt side of the market. I mean, you have seen everything, right from the global financial crisis, COVID, high interest rates. So I think the interest rates were also pretty high in 2001,
Yes.
and now we are much structurally much more lower. So you have seen even different interest cycles.
Yes.
So having seen that, what do you think has changed in the last 25 years, specifically on the debt side?
We have evolved. In 2001, I remember we were double-digit rates on government securities, and then it started to come down. Uh, the volatility, like you said, was much higher. Uh, I think a lot has changed, both in terms of the structure of the economy as well as how RBI has managed it. Especially, I think, since we started targeting inflation as a formal target, you've seen the impact of narrowing of inflation volatility and therefore more stability on interest rates. And so that, I think, has been one major change. Depth of the market has evolved. And with the size of the economy, the size of the market has expanded substantially. So it's been a journey of, like you said, seeing cycles where rates have gone up, rates have gone down. There have been a few crises in the interim. All of them providing learnings. All of them giving opportunities to understand how a macro framework helps define your portfolio management, how different market dynamics, both national and international, help percolate eventually to you making a decision about what to buy or what not to buy in a portfolio, what duration to run in a portfolio. So evolution, I think, is the key word here.
Okay. So one is that now many investors, one thing which what we get as the most queries and which they are not able to, is not palatable to them, is that many, and specifically now people who are above the 50s, they've seen double-digit interest rates, right? And now when they look at a single-digit interest rate, so it doesn't go down very well with them, in terms of the return.
Yes.
So when you have to, let us say, answer that type of a question to someone, because we try to explain them that inflation has also gone down and it's linked to that. So if you could throw some light in terms of, one is the real rate, right? The second is also in terms of the credit quality, because I think these two things also matter, and not just the standalone interest rate.
Absolutely.
So if you could actually throw some light on that, I think it would help.
Yeah. So like you said, real yield is what matters, right? So nominal is the headline. Nominal is one number, and people get obsessed with it. It used to be double digit at one time. At one point, I heard someone say that anything below 8% does not make sense, right? And that time inflation was 10%. So what people don't understand is to maintain your purchasing power, what you need is real yield, not nominal yield. Right? And the other difference which probably happens is sometimes your experienced inflation is higher than printed inflation. But on the whole, over the medium to long term, as long as you're getting reasonable real yields, the fixed income part of your portfolio is doing its work. Right? So the way I always tell people is that, look, your fixed income part of your portfolio is supposed to provide you stability. It is the anchor for your portfolio. And if it is the anchor of your portfolio, then by nature, it has to, one, obviously try to give you a real return so that your purchasing power is maintained. But more importantly, curtail risk. Be low volatility. Perform well when other parts of your portfolio are not performing well. So for a lot of retail investors, the way I try to explain it is that equity is a 15, 20, 25-year compounding journey. And the most important part is that you stay on this compounding journey. If you have a fixed income allocation in your portfolio, it helps you maintain your compounding journey. And if your compounding journey is not interrupted, my sense is you're much better off 80% staying for 25 years rather than 100% going down at the wrong time, you having to exit at the wrong time and then enter at the wrong time, right? So I think as a portfolio allocation, it helps in these two senses. It maintains purchasing power, provides stability, and in my view, most importantly, helps you maintain your compounding journey of your major equity allocation.
So how would you look at, let us say, the quality of the paper? Because I think that is also a very important factor.
I think it's the most important factor. So like we were discussing earlier, you want your fixed income portfolio to be stable and low risk, right? So in fixed income, which are the two major risks? One is duration, which is volatility of interest rates and how they move prices. So prices in fixed income are inverse to yields, right? So when yields go up, prices go down, and when yields go down, prices go up. So interest rate volatility is essentially the volatility of prices to change in rates. Second is credit risk. Credit risk is the risk that you've lent money to someone or you've bought a corporate's bond and the corporate is unable to service the debt, is unable to service the bond and consequently defaults on payments. To my mind, especially in Indian market, credit risk is the way higher risk. So I'll tell you why. It's not that duration does not give you volatility, it does. But duration, you can hedge the risk to some degree. It's a liquid market, so you can sell or reduce your position or reduce your duration if your view changes. Credit in our country is still pretty much a risk that you have to take on when you're buying. And after that, there are not too many exits. Right? So when things turn bad, I can always cut my duration. When things turn bad on the credit side, there is often very little chance to exit. Right? So essentially, you lose control over risk as soon as you made the investment. Then you are at the mercies of the market. And that is not to say that all credit is bad. Obviously, there's a hierarchy and you have to figure out what credit works for you, what does not. So what we try to think is in terms of risk-adjusted return, not absolute return or not absolute YTM, which is probably the other mistake that most investors make, that this obsession with just YTM. YTM is a promised yield. It is the return that you are promised that you will get. How real is the promise depends on the quality of the guy who's promising it. Right? So, if you do not adjust the YTM for the risk, then you're just fooling yourself.
Okay.
Right?
So I think, yeah, very important statement. Like, I think the moment you make the investment, your credit is determined at that point of time,
Yes.
right? And your duration you can actually always adjust. But if something goes wrong, we have seen that during COVID where liquidity was tight and most of them could not exit. The exit option itself was not available, and
Yes.
the
So,
price itself.
especially for our kind of mutual fund format portfolios where there is open exit, you don't have control over liabilities. Then the liquidity of the underlying asset in the portfolio becomes even more important. And unlike, let's say, more developed markets where there's a very active CDS market where you can hedge your credit risk, there is still not an option to do that in our markets yet.
Oh, right. We cannot hedge.
It's very
credit
difficult to
out
find a
here.
hedge for
Right,
credit
right.
risk.
So, Gautam, one more thing is that the investors have so many choices. I mean, forget about the liquid fund as an option, but you have short duration fund, and even sometimes the short duration fund itself is talking about 3 to 5 year instruments. The mindset of the Indian investor is more typically he's more attuned to how his long term and short term is determined by the income tax holding period. 1 year is more than 1 year is long term, less than 1 year is short term, right? So the moment when you say sometimes that this is a short term duration and it is 3 years, how is 3 years short term?
duration.
So you have, but for whatever it is,
Yes.
that's how the SEBI classification is. So when you have so many categories, we have gilt funds and corporate bond funds and credit risk funds, money market funds. So how would you guide an investor that if you could give some sort of a snapshot from your fund manager perspective, how an investor should look at the durations into his portfolio, that would help.
I think one, you have to look at your investment horizon. To a large degree, that determines your allocation pattern. Second, your appetite for volatility. Right? So, if let's say you've got money that you'll probably require in 3, 4, 5 months, then the idea is very clear, right? You'll put in a liquid fund. If you require money, if you think you'll keep the money for 1 year and you'll require it after that, you'll probably keep it in a money market or low duration fund. If, however, it's a more constant allocation or a permanent allocation, which is part of your overall asset allocation table, then it comes down to a question of your appetite for volatility, and in our very strong view, your ability to take credit risk. Right? So we believe that your fixed income part of your portfolio should be relatively low risk in terms of credit, and not all your fixed income portfolio can be, for example, a long duration fund. Right? Your core fixed income allocation has to be reasonably curtailed on both credit as well as duration risk. So you take a short term or a medium term fund, which is or a corporate bond fund, where typically you will find duration, average maturity or durations between 1 to let's say 3, 4. That gives you a reasonable enough investment horizon. At the same time, does not give you the kind of volatility like a long duration fund would. That, to my mind, would be a core allocation for any fixed income allocator. What we try to do is try to keep very high credit quality portfolios. So the other way to think of it is stick to probably PRCA rated funds, and then depending on your appetite for volatility, decide the fund you want to invest in. So for example, dynamic bond fund is probably a great option for someone who's okay with interim volatility, has a long enough investment horizon, and is in concurrence with the way the fund house or the fund manager operates the fund. Whereas there could be investors who are probably looking to invest for 20 years, but don't want to see too much volatility in their fixed income portfolio. So maybe a short term or a medium term fund makes more sense for them, or a corporate bond fund or a banking PSU fund makes more sense for them.
So so when you talked about asset allocation, right? So typically, I mean, if somebody would come to you as you also said that this actually debt actually brings stability to your equity portfolio in your overall scheme of things. So looking at from an overall perspective makes much more sense rather than just standalone as an investment, right? So according to you, what sort of an asset allocation an individual typically should have, in terms of your thought process,
Honestly, I think you are better equipped to answer that than I am. I think at a broad level, most people need to have some kind of fixed income allocation. Typically, how much that allocation is probably is a function of one, where you are in your career. Early on, you probably don't need as much. It is more, let's say, for liquidity management. But as you progress and your goals change, your fixed income allocation probably increases over time. There will be some goal-based allocation where, let's say, you need the money after 1.5, 2 years. There will be some permanent allocation which increases as you start to age. As you're probably coming closer to retirement, it'll increase even more. But maybe then you're looking for options where you get steady cash flows as well, right? So I think in terms of individual portfolios, it's best to consult a financial advisor and get advice on what works for a investor.
Okay.
But like you said, think of fixed income as part of your overall portfolio. Right? It's a diversifier.
Yeah.
And then what probably happens is that as long as you keep that big picture in mind, when equity is giving you 20% and you are looking at that 20% of a portfolio which is giving you 6%, it doesn't give you heartburns as long as you remember what that allocation is for.
Correct. Yeah, I think it makes more sense because equity will always be very, very volatile.
Yes.
And at least this will reduce that volatility to the extent of whatever asset allocation you have given.
Absolutely.
That's a choice which you have made. Okay. So now we have seen spike in the interest rates currently with the whole geopolitical scenario, and I think that whole the story which is panning out is not a normal playbook story. Every day the story changes.
We are all learning.
So where if you have to look at it from a macro perspective, because you are taking a 30,000 square feet macro view, right? In the terms of the interest rate cycle, do you still see some hikes coming in, or the interest rates going upward, or where do you see we are currently in the cycle today?
So look, we are in the back of RBI already having cut about 125 basis points. We are probably at the bottom, if not the bottom of rates. And as RBI has indicated in the last two policies, probably an extended pause. Now, the extended pause 3 months back was with the expectation that inflation would be fairly well anchored. With this spike in global commodity prices, you have another variable which has moved adversely, and which is probably the reason you saw the market react as well, right? So, India, to my mind, we are facing one challenge which is domestic, and that is the balance of payment and how it's affecting currencies. Second, obviously, is that we are major commodity importers. So, anytime commodity prices go up, it's a terms of trade shock. It has implications for inflation. It also has implications for currency. RBI has increased its inflation projections for next year, but still well within the range of 2 to 6%. So if this crisis, and it seems to be at least not going to the next level, or at least things seem to be stabilizing, then you are probably looking at a scenario where RBI, one, looks at pass-through and how much inflation actually feeds into the domestic market. And second variable, which frankly we didn't think of first when we saw this spike in crude prices, and which doesn't come to mind at the first time, is what kind of demand destruction is this going to cause, right? So the first order is that there's going to be a spike in headline inflation. But the second order effect is probably that you'll see some kind of demand destruction, especially if this sustains for a while. And then RBI is probably dealing with spike in headline inflation, which is a supply shock, followed by a slowdown in demand. And so my sense is they'll want to see how it plays out. And if it is the latter, then you probably want some kind of easing, maybe not necessarily in form of rates, but maybe in form of, let's say, credit guarantee by the government, and or some responses that you, let's say, saw in COVID last, maybe more liquidity than usual. So it's a fluid situation. How we are looking at it is that when we think that currently the market's priced in quite a lot of pessimism.
Okay.
Right? So one is expectation of our RBI rate moves. The other is how much of it we think is already in the price. So if you think there's enough in the price, then maybe you don't want to be very, very reserved or very, very defensive. Maybe you want to be, let's say, closer to median of your peer group of whichever fund group you're managing. So our sense is that there is enough priced in for us to be not necessarily very, very pessimistic right now on rates. In fact, over the last month or so, we've increased duration in most of our portfolios.
Okay.
So for the last 3-4 months, we've been relatively defensive because we thought that there was a lot of uncertainty that was not being priced in. Obviously, it was not to do with our expectation of a war breaking out and crude going to 120.
Correct.
But that is just an increased risk that also came on, and which probably provided a better entry point. So our sense is that as long as there's enough risk already in the price, one should start participating.
Okay. So you had also mentioned that there is a inverse relationship between the yields and the price, right? And I think the debt funds always take a hit when interest rates go up, and
Yes.
and vice versa. So you gain now. So what is a better time to invest when the the current yield is negative because now the interest rates have gone up, right? Or when the the current yield is very positive because whenever somebody sees a double-digit return in a debt fund, they like to invest.
I think it's the biggest mistake investors make in fixed income. You can't be backward-looking, especially in fixed income, right? If you see double-digit returns, that means yields have gone down to a decent degree.
Correct.
Right, from whatever the starting point was.
Correct.
So to expect that yields will go down by the same degree, and it's not necessarily true most times. So one of the biggest mistakes I think investors make is they redeem when they see negative rates. But negative returns typically mean that yields have gone up.
Correct.
Right, so that is typically the time when you should be looking to increase your allocation or looking to increase duration, all else being equal. However, I find that, like you said, maximum money seems to flow in once your 1 year return is double digit.
Correct.
Unfortunately, and like we as fund managers would like to see, like to get money to manage when when your 1 year return is probably not very good.
Correct.
Maybe it's low single digits, maybe it's below a liquid fund, and the time when investors are like, "Acha, why should I invest in a fund where the return is less than liquid fund?" Because that is a time of pessimism. That is probably when you're getting the best valuations.
So one just a thought which we is it a right thing to look at, like for example, mutual fund disclosures are fantastic. I mean, even on the debt side,
Yes.
so hats off to all the mutual funds for that. Now you also disclose the YTM and the modified yield. Everything is available for an investor to look at. So he knows what is the future yield going to be.
Yeah.
Now, if the future yield is more than the current yield, let us say 1 year, or I will look at a 1 year return because the recency price is over there.
Yes.
Would it be a good strategy for somebody to adopt if if your YTM in the portfolio is higher than the current yield?
By current yield, do you mean
The current return, because that's a past return. It's a past return.
You're saying
right?
YTM is higher
It's
than
like saying
past
that,
1 year,
yeah.
1 year return.
So, because at least the YTM gives the future return expected on the portfolio.
Yeah, the starting YTM is important, and like I said, how you arrive at the YTM is also important. Is your YTM high because you've increased the portion of AA minus in your portfolio, or is your YTM high because interest rates in general have gone up?
Correct.
Right. So keeping the risk in the portfolio constant, if the YTM has gone up, it's probably a better entry point.
Better entry, right?
If everything else remains the
So
same.
if I let us say I have looked at a gilt fund, I mean where I find that this fund has got the best YTM, then at least that is better. If it is higher than the current yield, it's a good time to get in. At least my future return will be better.
It's a good rule of thumb, I agree.
Rule of thumb, absolutely.
Yes, but I mean, it probably, at least as a starting point, should make you think, should I be increasing allocation to this segment?
Okay, fine that. So now a lot of things are even linked to even currency. The interest rates are even linked to inflation, currency, and what we are seeing is that a lot of dollars is going out. Now, previously, I mean, what some old school thought we used to have is that in US the interest rates were somewhere around 1%, 2%, and we used to be at 6-7%.
Yes.
So there was a fairly large gap in our interest rates, and that was one of the reasons why our currency would always depreciate, because the interest rate differential was pretty high.
Okay.
And currently, when you see the US and India interest rate differential is much narrower, but we saw a huge spike in the INR versus the dollar. So how does one relate, currency with interest rates, and how does one factor that into their account?
So a differential between two countries, to a large extent, are a function of the inflation differential between them. Of course, there are other variables to think about, but when we are just comparing two countries, look at INR and USD. There was a time when the inflation differential and interest rate differential was much higher. Now both seem to have converged. One, it's a function of obviously US coming off very low inflation and interest rates, and now being above the target of 2% inflation for a long time, and therefore interest rates being much higher than what they have been in the past. And for us, we having in some sense won the battle with inflation, or with very high inflation, to a degree where for most part over the last 7-8 years our inflation has been well within the 2 to 6 year band, which is the RBI mandate. So to one extent, so the convergence of rates, I would say to some degree, is a reflection of that process. It's also a function of capital flows. We've seen a reasonable amount of capital flows in this country post 2013-14, right up to last year and a half, when we started to reverse. So there is reasonable demand for the currency as well. So that would probably account for the differential in narrowing of differential in interest rates. Now, the challenges faced by INR in the current phase, our sense is that they are primarily on account of balance of payment. Historically, the challenge for our country used to be high current account. So whenever there was a spurt in growth, increase in growth rate, it would invariably be accompanied by a higher current account. And till 2.5%, it was reasonably manageable. That was our general experience. Once it started going upwards of 3.5%, where it funding it on a consistent basis became a challenge, and you'll find that each time it's gone up above 3.5% is when we face these challenges on the currency, challenges of funding that deficit, and therefore an increase in interest rates. Most famously, last in 2013. Since then, we've managed to bring down the current account deficit to a more manageable level. In fact, pre this crisis, we are probably going to do around 1% current account deficit, which has been fairly good in the historical context. However, in spite of that, your currency is facing challenges. That is because capital account, which has typically been the strong foot where we've seen money come in every year for the last several years, last year and a half, we've seen reasonable outflows. This year, last 2 years was 2 years of negative BOP after a very long time. Our sense is that a major reason for these capital outflows is that one, our valuations probably do not justify our growth levels, and foreign investors are finding other markets where you are either getting relatively cheaper valuations or closer cheaper valuations at similar growth. So the obvious solution is to in the near term probably fix the capital account, try to get some flows back. How does that happen? I think part of that is a valuation reset. Higher interest rates are one way of doing that. A depreciated currencies is another way of doing it. In fact, our equity markets have probably been sideways or slightly corrected. So over the last 1.5 years, valuations have improved. And hopefully at some point that it becomes compelling enough to get capital flows back into the country.
Okay, good. Thanks. With all these things which is happening around, then how do you unwind yourself from all this geopolitical tension and crude oil prices? How do you unwind yourself?
It's been a long time coming to a level where you can let go of work. Like the initial few years of managing money, it used to dominate my mind all the time. It like we were discussing earlier, get up first thing in the morning and see, acha, US mein kya hua, crude kahan hai.
Yeah.
It's not like it's going to change anything in the next 15 minutes, but it's so dominant that that's what you think about all the time. And then over time you realize that there are worries that lead to good outcomes, and there are worries that are just worries. So you find ways of distracting yourself. You find other things in life which are as meaningful, if not more. Be it family, be it friends, be it, in my case, I read a lot as a source of entertainment. So I read a lot, so that keeps me entertained, or movies, music, whatever you can to get, different experiences. I like to travel. So one learning is that you have to get away from the markets from time to time. You have to get away from your portfolios from time to time. And in fact, the day back from a long vacation is a time where there's probably most clarity. Before you get into the market, and then the nitty-gritties of the market slowly take over. So to get away is the only way.
Okay. So, we'll just end with a rapid fire. So, one metric you trust the most in fixed income.
I think we discussed real yield. I think that is one thing that one should look at.
Okay. Credit risk or interest rate risk, your bigger nightmare?
Credit risk. Interest rate risk can also give you anxiety, but you can always cut that risk if you want to. Credit risk, there's very little scope of exiting in a bad time. So definitely credit risk.
One word, RBI, friend or mood spoiler?
Both, depending on your position.
Duration calls, a skill, luck or jugaad?
Skill is getting your framework right, getting the call on the market right. Luck is if you happen to get a good price along with that. So if you got the call right, It is skill. If you got the call right and you got a great price or great entry point, then there is some amount of luck involved as well.
Okay. G6 or corporate bonds? What's your comfort food?
Uh, GSEC is dal chawal. It's consistent. It's there. Corporate bond is more like a thali. So I have a slight bias for corporate bonds.
Okay. The most overrated metric in debt funds?
Absolute YTM.
Okay.
By far. If you're not adjusting YTM for the risk, or if you don't know how you've got that YTM, whether it's a long duration AAA bond or a very short duration AA minus bond, then YTM by itself, without the risk associated with it, means absolutely nothing.
So that brings to the next question. YTM is a truth or illusion?
See, YTM is a promise. Depends on who's making the promise to you. If it's a AAA PSU entity or a government of India making that promise to you, it's pretty much the truth for the most part. And then as you go lower down the credit chain, that you have to take it with a pinch of salt.
Correct. One macro indicator you stock daily?
Depends on what is the flavor of the season for the markets. These days, it's crude prices.
Inflation prints, excitement or anxiety?
Used to be a lot more excitement and anxiety around inflation prints. Credit to RBI, they've one managed to maintain inflation within a reasonable band. So most times it's excitement or anxiety only to the extent of how far they are from our economist Srijit's estimate.
So thank you, Gautam. Thank you for being on the Ventura Spotlight and taking time out and explaining regarding how the debt market works.
Thank you. Thank you for inviting me. I had a good time.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully